Would you like to know the secret to getting rich? Yeah, let's talk about how you can get rich. This is a guaranteed method for getting rich. Would you like a guaranteed method? Yeah, okay. So we're going to start and we're going to talk about the money that you make. We're going to call those your earnings. And then we're going to talk about the money you spend. That's called spending. And then this we're going to call your savings. Have I lost anybody so far? Okay, now what we're going to do, we're going to take these savings and we're going to invest them. Now, let's talk about why each one of these things is important. By the way, how can I, so in the end, this investment, that's going to be my wealth, right? So how can I increase the amount that I can invest? Well, I have to increase my savings. 2 ways to increase your savings. What are they?
Increase earnings or decrease spending.
Yeah, you can either increase your earnings or you can decrease your spending. Now, let's talk about the ways that you can increase your earnings. You're doing one of them right now. Education, right? Getting additional education. Also, being willing to change jobs. Being willing to change jobs. I get paid less than market rate because at this point in my life, I'm just simply unwilling to go somewhere else, right? And they know that. Okay, so being willing to move. Also, being willing to take increases in your responsibilities, right? If you're willing to take on additional responsibilities, you can get more money. Yet again, something I'm unwilling to do. Okay, so, and also being willing to relocate. Not just changing companies, but being willing to relocate. Many of you are, let's see, who are my St. Louis people here? Are you wanting to go back to St. Louis? Wow, you are an odd St. Louis person. Usually I call St. Louis students boomerangs because St. Louis is great, I want to go right back. Like, great, whatever. But you don't, wherever you go on your first stop is not where they're going to bury you, most likely. Example, my first stop, Duncan, Oklahoma. I'll bet you've never even heard of Duncan, Oklahoma, right? Am I dead and buried there? No. You can live anywhere for 3 years, and I've learned something new everywhere I went, so be willing to move. Now let's talk about your spending. Do you really need to upgrade to the latest iPhone? Do you really need all those subscriptions you have to all those streaming services? You know, there are, it's just like we talked about the non-value added costs. Ask about what really adds value to your life and what doesn't. So for example, when my wife and I were first starting out, I had been living like a hobo. So I lived in a place where the rent was $100 a month and the door didn't even lock, right? And there was a cat that didn't belong to any of us. He just like hung out. And so when my wife and I went to get our first rent house together, we walked into this place and it was kind of a hellhole, but it was what I was used to, right? She's like, no, we're going to live better than that. And she was right. That was some important spending. So I don't want to get rid of that. But there's a lot of crap that you waste your money on. So we're going to increase our earnings and we're going to decrease our spending. That's going to increase our savings. And then we're going to invest that money. Now, what are we investing for? We are investing for retirement. And this is something that a lot of people don't understand. They're like, I want to invest so I can get money now. I'm like, you've got a damn job for that, right? So I don't need to be pulling anything off of my wealth at this point. In fact, I am saving as much as I can, or as much as this will allow me, and investing it. I don't need to be pulling from that. And so this whole idea of building this fleet of rent houses where you can have passive income. Have you heard this idea of passive income? By the way, anybody here own a rent house? It is not. Is it passive income? Barely. So is a renter more likely to clog their toilet, or are you more likely to clog your toilet?
They are.
They are. It's magic, right? And who do they call in the middle of the night? Who do you call when you clog your own toilet? Who do they call? You. Do you understand how this works? You don't need that money now anyway, right? So go ahead, invest it. Where would I tell you to invest it? I can give you a single piece of advice here that I will never regret having given you, and that is to buy the S&P 500 ETF. The ticker symbol is SPY. That's the ticker symbol. You go out, you buy that, and there you go. And has it worked for me? Absolutely. Do I live high off the hog because I know I've got wealth at the end? No, that's my wealth is for my retirement, right? Does that make sense? Okay, questions?
So why do you like SPY over VOO? I'm a big VOO guy.
You're a big VOO guy. Is VOO the
It's
vintage?
like Vanguard something.
Yeah.
I think it's a little cheaper than SPY.
It's a little cheaper than SPY? Okay. Well, first of all, I like SPY because VOO sounds kind of dorky. But, and I can write it on the board there without having to remember how to spell VOO. If you want to do that, good for you.
Good. 2 questions. How much of your savings could you invest in? And the second question is, why not index funds?
Okay, so this actually is an index fund. It's an index ETF. And so there are 2 kinds of index funds. There are ETFs and there are mutual funds. Yeah, so the ETFs actually have tax advantages over mutual funds because of capital gains taxes and things like that. So I actually prefer the ETFs. The other thing is ETFs are liquid. How many times a day can you buy or sell a mutual fund? Once. How many times a day can you buy or sell this? As many times as you can make your fingers do the ordering, right? So these ETFs definitely have an advantage. Now, between ETFs, you guys figure that out for yourself. At the end of my life, am I going to say, oh, crap, I'm $121 short because I didn't invest in the absolute most cost-efficient ETF? Probably not. I'll probably have other things on my mind. But it is good to look, and I have recently switched out one of mine because of the cost situation. The one that I use for small stocks. But we'll get into that after today. Other questions on this? By the way, how often do you think I check my portfolio value?
Once a year in Christmas.
Yeah, so you've read ahead. I check it once a year at Christmas. And if I'm up 25%, woohoo! If I'm down 10%, do I freak out about it? No. Well, it's so sad. I was here during the financial crisis, and one of the older professors who was getting close to retirement, he had his face up against, we used to have CNBC on a television, and he's like, ugh. And I'm like, what are you freaking out about? And it's just like these little day-to-day things don't matter. Now, as you get closer to retirement, do you need to change what you're invested in? Yeah, most likely. But we'll get into that. Questions? Yes?
How much should you invest?
Oh, how much to invest? Okay, so and I have a buddy who is a financial advisor, and he says 15% is what they typically tell people, 15%. So I actually did mine and figured it out, and I was investing over 30%. And so I had been basically raising my stuff every time the government would allow me to raise the cap on my pre-tax retirement. And then it hit me that I'm saving a boatload of money. And so I talked to my bro, and he's like, yeah, dude, that's crazy. And so I'm not willing to let go yet. I've just stopped raising the amount, right? And so as my salary, if it ever goes up, then my percentage will start to drop. Good question.
So 30% of your salary you invest in SPY?
Yes. Yep. In fact, it's a little more complex than this because I've got 80% in SPY, and I've got the MSCI World Capital or whatever.
International market, yeah.
Yeah. And so that's 20%. But other than that, it's really easy. And I actually talked to the financial advisor at TIAA-CREF, which is where professors have their money. And he had this optimized portfolio that he was going to offer me with all this other bells and whistles and horse shit. And And it turns out that my expected return and my risk were damn near identical. With just my 2 little ingredient soup, I was doing almost exactly as well as his thing. And his thing had 14% social investing. By the way, what's the goal of financial management? Maximize shareholder wealth. Do you think I give a flying fig about social investing? No, in fact, I've actually done research showing that social investing doesn't freaking pay, right? It may make you feel warm and fuzzy, but that's it, right? By the way, I encourage you all to invest in those social stocks. I'll invest everywhere else, and as a result, I'll have better returns, right? Does that make sense? If everybody wants to invest in the social stocks, what does that mean? These other stocks get discounted. You can buy them for a lower price, but the cash flows coming in are the same. Okay, wow, that got far deeper than I expected. Okay, so now let's talk about risk and return of individual securities. So, as humans, do we like risk? No. In fact, that's one of the ways that we tell people are mentally ill is if they actually prefer risk. There's something wrong with them. Now, we all have what's something called risk aversion if we're mentally healthy, and that is the amount which we dislike risk. Some of us are more risk averse than others, but if you are risk loving, then you probably need to talk to a therapist. Okay, now, knowing that risk is actually a bad thing. If I want to get you to take risks, what do I have to do? Say again? Yeah, I've got to pay you more. I'll give you an example. In my hometown, there were 3 primary industries. There were bed springs, cheese, and dynamite. Which one of those 3 do you think paid the best? Dynamite. Why? Yeah, it's risky. The cheese plant never blew up, right? Now, the cheese was safer than the bed spring plant because the bed spring plant, all those guys had at least one scar in a hand where a wire just shot straight through when they were trying to make bed springs. And so that was a little riskier. Of course, it had to pay more. Best job in town, the dynamite plant. You sit there on a one-legged stool. By the way, do you know why it's a one-legged stool? How hard is it to fall asleep on a one-legged stool? That takes a lot of talent, right? But your job is to sit there and watch that thing and make sure nothing goes straight to hell, right? And so you're on the one-legged stool, but you're making the best money in town. That's why my dad worked at the dynamite plant. Okay, risk and return. They have to go that way. It has to go that way for your financial investments. It has to go that way for your real investments. For instance, if you're out there buying real estate in a really bad neighborhood, you better get some really good return out of it, right? Okay, so let's talk about returns, the idea of returns. And we're talking here about financial securities. And there are 2 ways that we get returns off of financial securities. There may be periodic payments, for example, on stocks. There may be dividends. There don't have to be dividends, but there may be dividends. On bonds, we will have periodic interest payments, which we call coupons. And the other thing that happens is the capital gain. If I sell this thing for more than I paid for it, then I get a capital gain. So those are the 2 ways that I can make money from owning a financial security. So for the purposes of our discussion here, I'm going to use stocks, but you can make this same kind of argument with any sort of financial instrument. We're going to talk first about dollar returns. And dollar returns are talking about the actual number of dollars that you get as a result of making an investment. So here is our example. You've bought 100 shares at $37 a share. The stock pays an annual dividend of $1.85 per share. At the end of the year, the stock is selling for $40.33. What is your dollar return on the stock investment for the year? Now here's what I would recommend that you do. I would recommend you figure out all this stuff on a per share basis, and then at the end multiply by the number of shares. Why? Because I'm lazy and I'm saving having to multiply by 100 2 more times, right? So I'm going to say, let's talk about per share. I'm paying $37 per share, and I'm going to be getting $1.85 per share just from the dividends. But what is my other source of income here if I sell that stock at the end of the year? I bought it for 37. I'm selling it for, yeah, it's capital gain of how much? Yeah, $3.33, because it's 33 minus 37 gives me $3.33. Now, if I take that $3.33 and add it to $1.85, what do I have then? $5.18. So if I've got $5.18 in both dividends and capital gains for the year, and I've got 100 shares, then what's my total dollar return? 518. Does that make sense? Okay. So that's what's going on right here. Now, right now you're saying, wow, this is pretty easy, and it makes perfect sense, and it does. But there's a problem. It doesn't tell you how, it doesn't describe the total performance. And here's why. Let's assume that you and I are at the cocktail party, and of course people at cocktail parties discuss their recent stock returns. That's what happens at cocktail parties. And I say, I recently made an investment with $518 of total return. Do you know whether to be impressed or not? No. What's missing?
What your cost would be.
Yeah, how much did I have to invest? So I say, well, I've got total returns of $518. And you say, how much did you have to invest for that? If I say 1,000, you're going to be impressed. If I say 1 million, you're going to say, what an idiot. I can do better than that in my savings account, right? And so that's why this measure and none of these measures are going to be perfect, because they're all going to leave out just a little bit of information. So now let's take a look at our percentage returns. And our percentage returns, the total percentage return, is the sum of two different percentages. The first one we call the dividend yield. The dividend yield, now we get into these little subscripts. So let me tell you what the subscripts mean. The dividend yield here, that is the dividend at time t plus 1 divided by the price at time t. Now what does that mean? It means it's the dividend at the end of the year divided by the stock price at the beginning of the year. And here's the logic. How much did I have to pay at time 0 in order to be able to get that money at time 1? And so that's why it is expressed the way it is. And we call that thing the dividend yield. But we also have our percentage return from the capital gains yield, or from the capital gains. So we call that the capital gains yield. And here's how it works. I'm going to take the price at time t plus 1. I'm going to subtract the price at time t, and then I'm going to divide by the price at time t. And so that p sub t plus 1 minus p sub t, that's going to be our $3.33. And then that p sub t is going to be our 37. Now, there is another way you can do this. If I've got p sub t plus 1 minus p sub 1 divided by p sub 1, I could say that is the same as p sub t plus 1 over p sub 1 minus p sub 1 over p sub 1. Have I broken any algebraic laws? I think I'm good. Now, what happens over here? Oh, I'm sorry, this isn't p sub 1, it's p sub t. Phew. Yeah, these cancel out and become 1. And so this is actually P sub t plus 1 divided by P sub t minus 1 is another way to think of that. It's actually quicker if you do it, if you just do P sub t plus 1 divided by P sub t and your calculator gives you 1.08. What is your capital gains yield? Just 8%, right? So this can be easier if you're a mathematical thinker. Okay, now how do we come up with our total percentage return? Well, we can add together that dividend yield and the capital gains yield. We just add those together, and that gives us our total percentage return. So let's talk about our example. I can find the dividend yield by taking the dividend at time t plus 1, which is $1.85, divide by P sub t, which is 37. And when I do that, it gives me 0.05 or 5%. And I can take my capital gains of 40.33, that's P sub t plus 1, minus P sub t of 37 gives me $3.33, divide by P sub t, and that gives me 9%. And when I add 5% and 9% together, I get 14%. So let's check our work here and see if these two things are actually telling us the same thing. My initial investment was 37 times 100. Does that sound right? If I take 37 times 100 and I multiply it by 14%, what I'm going to get is $518. So that's how those two things are related. And if you can't get the math to work out that way, you've messed one, the other, or both up. Okay, so let's talk about the information that might be lacking from here. You and I are at the cocktail party, and I'm telling you that I made 74% on an investment. Are you impressed? You know, when you first hear that number, and then you say, well, wait a minute, how much did you invest? And I say, $2. I can't even buy you a can of Coke with my profits, right? So that's, neither one of these things really tell you everything that you want to know. Questions? Okay, now, what I want to tell you next is that different things return different amounts based on the risk. And the best way to show that is on this chart right here. And the first thing I want to tell you about this chart is that it's weird. Look at the axis on the vertical axis. It goes from 0 up to 1, and what are you expecting to see next? 2. But instead we see 10, and then we see 100, and then we see 1,000. This is what's called a log normal chart. And the reason that we do this is because if we didn't, it would all be whoop, it would look like this, and it would be so strange because a 10% return down on the bottom would be tiny, and a 10% return up at the top would be huge. So the reason we do this is what happens is that the same vertical distance on the chart represents the same amount of return. So it allows us to compare these things more easily and allows us to keep a clear head in the whole thing. Now, something you need to know about financial data for American financial markets. We have actually been selling stocks under the buttonwood tree in New York City on Wall Street. It's an actual street. Since for like 300 plus years. But do you think they kept good records? No. And so we can't really tell you what happened as far as asset returns back then. Someone, and I don't know who, but someone figured out on January 1st, 1926, to start writing down how much each stock was worth at the end of the day. And so we have data going all the way back to January 1st, 1926. And so that's where our chart starts. It's January 1st, 1926. And we have several things on here. The first thing on here is something that you cannot invest in, but it's something that you all have very recently experienced in a real way. It's called inflation, right? And so what we're really saying here is that this chart's as of 2013, that as of 2013, it would cost you about $13 to buy the same amount of stuff that $1 could buy in 1926. Man, from my conversations with my grandfather, that sounds about right. He would always tell me about how a candy bar used to be a nickel and things like that. Okay, so that's inflation. Now, why do we even put it up there? Because if we are looking to actually increase our wealth through investing, we have to beat inflation. If I am investing at 3%, and inflation is 5%, I'm actually losing purchasing power. And that's not the reason that we invest. We want a positive, real return. And we'll get to what a real return is in chapter 5. Okay, now the next thing above that is a line that says Treasury bills. What are Treasury bills? They are the short-term debt of the United States government. And for purposes, whenever we look at a chart like this, we always look at the 3-month Treasury bill. 3-month Treasury bill. There are two kinds of risk when we loan money to people. The first risk is called default risk. What is default risk? Yeah, it's the risk that they don't pay. Have you ever loaned money to a friend and then they didn't pay you? Yeah, you have experienced default. And so there's always that risk. With the United States government, in theory, what is the default risk? 0. Now I say in theory. Why is it that the United States government is supposedly default risk proof? It's never what? No, that's so you could actually go below the inflation line without defaulting.
Isn't there a law or something that says that
Okay, so basically it comes down to this. The government, in theory, has the power to raise taxes, so they'll always be able to pay their bills. Now, is that always easy in a democracy? No. And so you have, basically the only guy in my entire lifetime that I remember saying he was going to raise taxes as president was a guy named Walter Mondale, 1984. And the only state that he carried in that election of 1984 was his home state of Minnesota. That was it, right? Everyone else is like, pfft. Okay. So the second thing, this is the one you students usually mention. What else can the government do? Print more money. Phew! Easy solution. I'm going to ask our African experts, what happened in Zimbabwe when they started printing lots and lots of money?
It lost value.
Yeah, it loses value. Before long, you're having to carry a stack of these notes to buy a loaf of bread. So that's really not a good answer, right? Is printing more money. Okay, now, but those are in theory the reason that the United States government is default risk-free. The big question I want to ask you is, do you think the United States government has ever defaulted on its loans?
I feel like it.
Yeah.
What, like War of 1812?
Oh, damn, he is good. Yeah. Okay. So you must have been watching the same YouTube that I was, or you just pay attention. Okay. So here's the idea. If we roll back to the American Revolutionary War, by the way, we used to be under the British. I think Ghana was under the British too. Those guys got around, right? Okay. So that's why we speak English. We were under the British, and then we decided we didn't like paying taxes, surprisingly. And so what did we do? We revolt. Now, a group of people from Europe helped us out. Who was it? The French. Do you think the French did that because they love Americans? No, the French don't like anybody, but they especially hate the British. And they're like, well, hey, if we give these Americans some money and some gunpowder and stuff, they can put a thumb in the eye of the British for us, and we don't have to. Yeah, isn't that great? Okay, so, by the way, this is a common game. We did that to the Russians when they were in Afghanistan, and guess what they did to us when we were in Afghanistan? Same damn thing. Okay, now on with the story. So we borrow a bunch of money from the French, and we're actually making our payments along until the War of 1812. And we're like, this war is kind of expensive. Sorry, monsieur. We're going to have to default on that debt. That was the last time. That was the last time. So it is possible for the United States government to default. It just hasn't happened in a very, very long time. Okay, so we're talking about zero default risk. The other kind of risk, this is one that people don't think about a lot, is called price or interest rate risk. So hopefully you guys remember this formula. What's that the formula for? Present value, right? Okay, now the price or value of anything is the present value of the future cash flows discounted at a rate appropriate to the risk. Now, let's see what happens when R goes up. What happens to the present value? Yeah, it goes down. And what happens when R goes down? Yeah, present value goes up. They move in the opposite direction. And so we know that as interest rates change in the overall economy, the value of the debt will change in the opposite direction. And so right now, where interest rates are floating down, and so the value of those debt assets should be going up. What's really bad, though, is when you have to raise interest rates in a hurry, like we did when we had the inflation threat a couple, 3 years ago. What happens to the value of all of the debt assets at that point? Whoop, they go down, right? Because interest rates are going up. And in fact, we would call that a bond market bloodbath, because you can lose a lot of money in a hurry based on that. Okay, now, I want you to think about, though, what's going to be riskier. If I have a 3-month treasury bill, that means that money is due in 0.25 of a year. And so whatever little change I've got in R here gets magnified to the 0.25 power. So, tiny. But what if instead it's a 30-year bond? Then your big future value out there at the end, that magnifies to the 30th power. And so you're going to see a whole lot more interest rate risk, price or interest rate risk, as the time to maturity, the time to payment, gets longer and longer and longer. And so that's why we say the United States Treasury bill is basically the safest thing you can have, because in theory it has no default risk, and it's got this tiny, tiny, tiny price risk, because this change in R is only multiplied to the 0.25 power. As a result, low risk, low return. You invest $1 in 1925, you end up, or 1926, you end up with $20.57 by the end of the period. That actually sounds pretty good, right? We've beaten inflation. We've actually created an extra almost $8 of the ability to consume. So that sounds pretty good. Until you see that if you had just invested in long-term government bonds instead, you would have $123.81. By the way, long-term government bonds, same borrower, the United States government. So in theory, the default risk is identically the same, 0. Why then are long-term bonds, long-term government bonds, riskier than Treasury bills?
Longer to pay off.
Yeah, it's a longer time to pay off. These guys are out here to 30 years. And so this price or interest rate risk it's magnified to the 30th power. It's much greater. As a result, people require a higher return to hold them. And so you could see you make 6 times as much when you invest in the long-term government bonds as when you invest in the 3-month Treasury bills. Okay, now I want you to look at these lines for Treasury bills and the long-term government bonds. That Treasury bill line is as smooth as a baby's bottom. There's barely any movement in it at all. But take a look at the long-term government bonds. Now we start to see this wiggliness. That wiggliness represents positive and negative returns, right? And so the more of this wiggliness we have and the bigger the wiggle, the riskier this thing is. And so I can tell how risky something is simply by looking at the line. The more of that I see, the riskier it is. Now let's discuss why that is. If I am about to retire and I'm going to depend totally on my savings for retirement, I want to, on the day when I step off of my job into retirement, I want to be pretty darn sure that my investments are going to be worth basically what they were the day before, right? Yeah. I don't want to step off into a whoa, right? And it's so funny to watch. Finance professors should know about changing their portfolio to get less risky over time because we know we're going to retire. By the way, we know we're going to die, right? And so we could just back away from that. Retirement, if we're lucky, we'll be able to do that. What do you think professors actually do? Yeah, we'd say risk on. And so it's so funny to watch professor retirements or finance professor retirements because you would think that they would remain uniform. But during financial crises, everybody says, I'm going to stay another couple of years.
So do you think like your hint to getting rich if we'd be investing in more risky assets since we're young?
Oh, yeah, absolutely. Oh, my goodness. Okay, so yeah, when you're young, that's when you can take risks. And you should be definitely risk on. But of course, you want to be rewarded for the risk. And we'll see that there's some crazy crap you can do where you won't get rewarded appropriately, and we'll try to steer you away from that. But yeah, doing this SPY thing at your age makes all the sense in the world. In fact, I'm going to show you something that even makes maybe a little more sense at your age. Good question. Other questions? Okay, now we are on to, by the way, there's something missing from this chart. Between long-term government bonds and large company stocks, we should have large company bonds. Why would large company bonds be riskier than long-term government bonds? What types of risk do we say long-term government bonds have? Yeah, it's got price or interest rate risk, but does it have default risk? No. What about long-term corporate bonds? They've got the same price or interest rate risk, but what other kind of risk do they have? Yeah, default risk. Ask anybody who owned Toys R Us bonds or General Motors bonds or Chrysler bonds, and they can tell you that bonds have corporate bonds have default risk. And so there should be another line up here between long-term government bonds and the large company stocks. Now let's talk about why corporate bonds would be safer than the stocks of the same company. It all comes down to the order in which people get paid in bankruptcy. Remember when we were talking about maximizing shareholder wealth being the answer, we said that there were all these people in line to get paid before the common shareholders. The bondholders at a corporation get paid before the shareholders. Therefore, their position is safer And so what does the return look like? It's got to be lower. Does that make sense? Okay. So we've got these long-term corporate bonds, and then we have large company stocks and small company stocks. If I had invested in large company stocks, we're talking like the S&P 500 here, I would be looking at, for my $1 investment, I would have $3,532.56. That seems pretty darn good. Until you see the small company stocks. I would have $18,364.60. You remember I told you there might be something that makes more sense for really young people? Small company stocks, historically. Things have been a little funky lately. I have, I call it my fun money or my gambling money, and I've got it invested, and even my gambling is diversified. I've got it in the S&P 600, which is small stocks, and the Russell 2000, which is small stocks. And by the way, I switched from S&P 600 to the Russell 2000 because of the costs that you pointed out earlier. Okay, so there we've got a boatload of these small stocks. Am I depending on that stuff to pay off today? No. Am I depending on it to pay off tomorrow? No. In fact, as I said earlier, it's my fun money, my gambling money. What kind of money, I'm not saying to gamble, but if you're going to gamble, what kind of money should you gamble with? Money you're willing to lose, right? And that's, at my age, any money I put into there has to be money I'm willing to lose. And by the way, my S&P 500 has, as of late, been outperforming my small stocks. Will that always be true? No, historically we can see that it's not. It's really hard to get it in your head that what's going on today isn't necessarily in the historical context, and that more often than not, things go back to the way they were before. How many times have you heard, oh, but we're in a new era, or this is the new normal? Horse shit. This stuff, we always like, oh, it's different this time. I remember this during the dot-com boom. Oh, it's different this time. No, it was the same crap. And by the way, AI, you guys are saying, oh, but it's different this time. Mark my words. I can't tell you the date, but I can tell you there will be an AI bust, and stock prices will fall. And because we've had this talk, you won't crap your pants. You'll just sit tight, right? Hold on to your stuff and wait for things to come back. I had a colleague named Kenneth. He was a salesman, and he was 62 years old, and the year was 2001. It was about the time of the dot-com bust. He would come into the office every day, and he's like, yep, portfolio's worth $2 million today. I'm like, that's great, Kenneth. I said, by the way, what are you invested in? He says, 100% internet stocks. I say, Kenneth, that's terribly undiversified. He says, doesn't make any damn sense to invest anywhere else. That's where the money's at. I said, okay, you go, Kenneth. Before I left that place in 2002, Kenneth's portfolio value was down to around $200,000. Last I heard, Kenneth was still shuffling his old ass around selling plastic pellets. Why? Because he had a terribly undiversified portfolio when one of these busts hit. That's also how you protect yourself from these busts. Should you be 100% AI stocks? It would be insane. Questions?
So do you, like, AI cannot predict what's not go up, what's not go down?
Okay, so some people have actually ran some experiments, and there have been, but the problem is, you come up with basically anecdotal. So, well, I'm going to have AI pick 12 stocks. Well, the 12 that they pick this time may slightly outperform the 12 that I pick using fundamental analysis or whatever. Or they may outperform the S&P 500. But the question is, would they do that again? And here's what I know. Whenever you guys ever play poker, and when you're just playing for chips, you win, 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 right? But the second you start playing for money, what happens? Suddenly, I can now lose, right? And that's what I would tell you about letting AI pick stocks is you could run through that 100 times, and you're like, damn, this is the medicine, right? And then you're like, okay, I'm all in. I guarantee you everything will go straight to hell. questions?
I have one more question.
Go ahead.
Why do you think we should invest in these DeFi instead of like cryptocurrency or maybe limited natural resources?
Okay, let's talk about cryptocurrency. Cryptocurrency has no value in and of itself. Cryptocurrency's value is entirely based on this concept. As long as I can find a bigger fool than me to buy it for more than I spent on it, I'm still good, right? Now, what does that mean if you're investing in crypto? Everybody in that game is a fool. You just have to be looking for a bigger fool. Now, usually, where do we find fools? I'm using that term harshly here, but where do we find these people who are willing to jump straight into this stuff? How about young people, right? And so you guys, you're young, you hadn't had my class yet, you were young and inexperienced, you didn't realize how dangerous this was, so you put some money into it. Now, you're figuring out, oh crap, this stuff's kryptonite, or this stuff's a uranium or whatever, I need to get rid of it. You turn around to find a bigger fool. Here's the problem. Population of young people is dropping. So therefore, the population of fools is dropping. You're going to have a harder and harder time finding someone to take over this radioactive shit. Charlie Munger, he's Warren Buffett's sidekick. Actually, he was the brains behind Berkshire Hathaway. And he said, you could see a bunch of people trading turds with each other. You guys know what a turd is? You can see people trading turds with each other. You don't say, I gotta get involved in that, right? And by the way, what happened to the price of Bitcoin the other day? Yeah, it just went, boom, right? Took a big dump.
So, not all your money, but would you say that a little bit is not like to play with your gambling money, you know what I mean?
Yeah, okay, so purely gambling money, sure.
Okay.
Yeah.
You just wouldn't recommend it from like a investing perspective.
No, I'm like, I'm going to put all my retirement money in Bitcoin. In fact, what I'm going to do, I'm even a bigger idiot than that. I'm going to go borrow some real money and buy this fake money. That sounds freaking smart, right? It sounds smart right up until the price takes a big dump.
Like last year in my last finance class, I felt like a genius.
Oh.
I bought super low and it went up to 120.
Oh, yeah.
Unbeatable.
Oh, yeah. Okay, so let's talk about this part of human nature. You notice he said he felt like a genius. Did he say, I felt like I just got really lucky? No.
Yeah.
Whenever we win, we attribute it to our skill. And whenever we lose, we attribute it to luck. It's just like, I think I told you about my finance professor, and he told us about all these great trades he'd made. And I'm like, why are you still here? I didn't tell you about the bad ones, right? Yeah, stay away from that stuff. Crypto is smoke and mirrors. And, you know, it may not be in the next 5 years that it busts. So whenever you make a prediction, you can either predict the event or the time, but don't predict both. So here's my prediction. There's going to be a big reckoning on the whole crypto thing. And so let's talk about where the money's coming from that's pumping crypto up. Same place the money was coming from to pump up silver and gold. People in China are not allowed to, there's like really tight controls on what they can invest in. And so if they can illicitly figure out how to invest in silver, gold, crypto, what happens to the value of those things? Yeah, it's going to go up. Now, and just for sake of argument, let's say something changed in China tomorrow and they moved to a free economy. And now anybody can invest in truly productive assets. What happens to the amount of money available for crypto, silver, and gold? Dries up, right? What's going to happen to the value of crypto, silver, and gold? Whew, right? Won't even see it coming. Sorry to break your bubble, your dreams of cryptocurrency wealth. Like I said, as long as you can sell out before everything takes a huge dump. I did have a professor, it was December of 1999, and he had been heavily invested in the internet stocks. And he says, I just sold all my internet stocks. And we're like, huh? And then, boy, it wasn't long before we figured out the man was a freaking genius. So if you can get off the ladder, off the escalator at the exact right time, then you're golden. Can any of you predict the future with certainty? If you can, come to my office. We'll get rich together. Okay, now let's talk about why small company stocks are riskier than large company stocks.
More likely a small company to go out of business.
Okay, why?
Single owners, sole proprietors, have all the liability.
Yeah, okay, so these small companies are not sole proprietorships. These are publicly traded firms, right? These are like Russell 2000 type firms. But they are small, and typically small firms, are they doing a lot of different things? No, they're usually doing one thing. Everybody tends to start out with one product. With Apple, it was the Apple II computer, boom, that was it. When you are only doing one product, your product line is not diversified. And so if suddenly the demand for that one product that you make goes away, whew, you're a goner. Does that make sense? So let's talk about the green energy thing. Everybody was like thinking, oh, we're going to have windmills everywhere. And so governments were funneling all sorts of money into the construction of windmills. And you've got a tiny Chinese startup making windmills. And then you've got General Electric over here in the United States making windmills. The Chinese company was 100% in on the windmill thing. With GE, the windmill business was a rounding error. You know, it's not that big. So when the government stopped subsidizing windmills, what happens to GE? Not much. What happens to the Chinese startup? Right? Totally trashes it. So that's the first thing. Small companies tend not to be diversified. The second thing, how do small companies, where do large companies come from? Unless they're started by a government, how do large companies start? They all start out as small companies. They all start out as small companies. Now, when I was 1996, I'm down in Louisiana, and we go alligator hunting. And there are all sorts of different sizes of alligators. And we see this 12-foot alligator, and one of my Cajun buddies says, whoa, he must be smart. I'm like, you could tell by how long he is, how smart he is? He says, no, man. He says, the little dumb ones get killed. He says, they got to be smart to get that big. Does that make sense? So what happens to dumb small companies? Yeah, they die, right? And so it's the smart small companies that turn into big companies. And so we're talking about there's a whole lot of additional reason to think that they might fail. Now, I had a student say, wait a minute, these are just the small companies that succeeded. I say, no, no, no. This is survivorship bias-free data. It includes not only the ones that grow up to be big gators, but also the ones that die. And he says, wow. He says, what if we could pick out the ones that are going to survive and only invest in them? I said, that's brilliant. Come by my office and tell me which ones are going to survive. Because if you can tell the future with perfection, you and I are going to get rich together, right? Can you do that? No. Questions? Okay, now, as young people, would I encourage you to invest in small company stocks? Yes. And why are small company stocks different than crypto? Small companies are actually creating something. They're actually producing wealth. They're taking labor, capital, materials, and creating something that's of greater value than the labor, capital, and materials that went into it. And because you own part of that, you get part of it. Does that make sense? Where's the value created with cryptocurrency? The answer is there is none. There is none. There is no value created by crypto.
What if you have a small company that worked exclusively in cryptocurrency?
Okay, so this is an interesting question. He's asking, what if I had a small company that worked in crypto? And the answer is this. It reminds me of the gold rush of 1849. So you've got, so you read the newspaper, gold discovered at Sutter's Mill, California. And you're like, I know what I'm going to do. I'm going to go out to California and I'm going to mine for gold and I'm going to get rich. How many of those people actually got rich? Very few, just a handful, right? Now, who really did okay off that thing? The people who sold the supplies to the miners. Do you see that? Anybody here wearing Levi Strauss jeans? You are, okay. So Levi Strauss went out to California with the intention of making tents for miners. And so he had all this great material for tents. It was called denim. And he got out there and he saw that those poor guys were out there in like slacks like mine, and the knees were getting worn out of them, the butts were getting worn out of them. You don't want to see that. So what does he do? He's like, poof, I'll make pants for these guys. And as a result, he got rich even before they took off as a fashion staple, right? So that's where I always want to be. I don't want to be the miner. I want to be the person selling stuff to the miner. So you could be safer selling those mining rigs. However, you're still pegged to the value of that thing. What you've got to hope is that there are bigger fools out there who want to buy more of this mining gear to go after this. And they say, oh, wait a minute, Bitcoin's going even further down. I need to mine more of them, right? So you're hoping that idiots with money are out there to buy your stuff. It is safer than doing the mining yourself, but it's like one step safer. Does that make sense? Did you understand the analogy with the gold mining? Okay.
So, is it along the same lines as companies like WeWork and that one we did the discussion on a couple weeks ago with Marriott,
Oh, yeah.
like they're not working in Bitcoin, obviously, but they're not producing anything either.
Yeah. And once again, we have the bigger fool problem. So what did WeWork do? They took out long-term leases, and then they turned around and gave out short-term leases. Now, in theory, if you add all the short-term leases together, it's going to be more than the long-term lease money, and that should give you your profit. Two problems. Number one, what if there's a pandemic and people decide not to work at the office anymore? Well, that short-term lease just goes away, right? And the other problem is that the people who were investing in that model, they bought into Adam, what was his name, Newman? They bought into Adam Newman's bullshit that his firm was more like a tech firm. I'm like, no, you're doing the same business that people have done for a long time. You just sexed it up, you threw some parties, you drank some tequila, and suddenly you're getting tech firm valuations. What kind of investors was Adam Newman looking for? Other questions?
I just have a question about my Roth.
Okay.
So I want to make sure I understand Roths, right? The tax advantage, So like, if I'm, so say for example, I've got like, I have Amazon, and it's like way up one day, and I sell it, and then like literally 2 days later I buy it back for $5 cheaper. Even if I've only made like, I don't know, 20, 25 bucks, that's still good. It's better than nothing. But as long as I'm not pulling it out of my Roth, that's never going to be like realized gains, so it's never going to be taxed,
So in
right?
theory, your Roth, nothing that you pull out of your Roth is after age, 59 and a half, is going to be taxed in any way, shape, or form.
Okay.
So the theory with the Roth, so difference between a Roth IRA and a regular IRA or 401k is that you pay the taxes up front. So I go ahead and pay my taxes on my income, and then with the money that's left, I can buy stock inside this Roth device. And in theory, down the line, I won't have to pay taxes on the capital gains, dividends, any of that sort of stuff. Now, let me tell you why I prefer the pre-tax IRA or 401k. How many of you think you can trust the government? Anybody here think they can trust the government? If you think you can trust the government, just ask your Native American friends if you can trust the government. Now, in my situation, because all of my retirement savings is pre-tax, I know I'm not paying the taxes now. And I know I'm going to be paying taxes at the end. The problem with the Roth is they say, oh yeah, go ahead and pay your taxes now. Oh, we won't tax it down the road. How many of you guys heard that socialism is popular these days? Do you know what socialism is? Taking crap away from people that doesn't belong to you and giving it to other people, or basically, of course you got to keep half of it for yourself because that's how that works. Do you see how if you've got your money in a Roth IRA and the time comes when we decide we're going to have the great warm collectivist society, you're like, oh, sorry about that, pal. We're going to tax your Roth anyway.
If you even live that long.
Yeah. So there's uncertainty, right? And so I am giving up the uncertainty of what future tax rates are going to be to have the certainty of knowing I didn't pay taxes on it today.
Okay, but bottom line, it's not the worst idea in the world. I trade like every day.
Oh, no.
I love trading, and
As long as you're not paying commissions, inside your Roth, you're not creating any sort of tax consequence for doing so.
Okay.
Now, I will tell you this. People who trade less have better returns.
I know I'm gonna get burned one day.
Yeah. And in fact, one of the things that we did in finance, some of my colleagues, they looked at investors. And they had investor data, and they divided it cleanly along, back then we only had two genders, they divided it cleanly. And they said, whoa, women get better returns than men. And they looked, and the only thing that was truly different between women and men was how often they traded. Women tend to buy and hold. Men think of it like freaking fantasy football, right? Whew. Wow, that was a whole lot of talk about one chart.
So you're investing 15% of your savings in SPY,
Yep.
or just in long term.
Mhm.
What's a good retirement age?
Ooh.
Especially like our age.
Okay, so what's a good retirement age? So you guys know that if you wait till 70 to claim Social Security, that you get way more, right? If you claim it at 62, you get way less. And so that's one of the things that comes into this. Another thing to think about is how long do you plan to live? Let's say that at my age, let's say I'm 54, and I go in tomorrow and I get diagnosed with cancer. Do I really have to have all this money to fund my living to 95 retirement dream if I'm probably going to die of cancer? No. So I would go ahead and retire, right? Even though I'm not old enough to really retire. So there's all these things. This is an amazing question, and the answer is different for every single one of you. In fact, the answer is different between me and my wife. My wife wants to retire earlier. I want to retire later. We've done some negotiating. Yeah, it's hard. It's hard to figure out. And the other thing to think about is, what are your costs going to be? When you hit 65, you're eligible for something called Medicare. No, Medicaid's for poor people. Medicare's for old people. Now, you can be both old and poor. I don't know if you can draw both. But when I get to be 65, then I'm going to have a whole lot more certainty about my health care costs. And so my original plan was to wait until my wife was 65, I'll be 66, and we'll retire then, right? But, who knows? We'll see. If I've got a bad cough at 62, I don't know. Yeah, it's hard to know. Good question. I'm sorry I don't have a definitive answer for you. If I just say 67, would you feel good about it?
That's fine.
Oh, don't ever believe anyone when they tell you the number. By the way, everyone thinks that being retired is like being on vacation every day. That is total crap. And here's why. The only reason your leisure time has value is because you're comparing it to work, right? And so when you stop working, and now you've got all this leisure time, by the way, your supply of leisure time went way up, your demand didn't. So what's the value of your leisure time now? Yeah. Plus you don't have any money, right? If you retire too early, you don't have any money. So work long enough to be able to afford to do the fun things, and then figure out some sort of side gig. So you can go out and keep yourself entertained, keep yourself mentally sharp. Okay, so what we got here are called histograms. And a histogram is where you take things and you put them into buckets. And the buckets that we have here are 10% return increments. And what we've done is, for every year, we figured out which one of these return buckets goes in, and we put the year number in that bucket. And so, for example, in the year 1933, or let's say go with 1954. 1954, the return was between 50 and 60%. So that's what that means. Now, first thing I want you to do is look at that top picture and tell me what it reminds you of. What does it look like? Yeah, the normal distribution, right? What did you say? A what? Okay. I'm still not understanding. People keep laughing every time you try to say it. Let's try one.
Middle finger.
The middle finger! All right. You know, I kind of see it. If you had more than 5 fingers, it might work out that way. Okay, now, back to the story. It looks like the normal distribution. And in fact, we say that stocks, we tend to think of them as normally distributed, the returns. With one exception, we know that they're truncated down here at minus 100%. And how do we know that? Because there's limited liability in a stock. Stock prices can never go negative. The most you can ever lose is 100%. Can you have more than positive 100% return? Absolutely you can. Okay, now back to the story. I want to tell you a story about an investor. And it was 1927, and he's talking to his buddy. And his buddy says, man, you got to get into this stock market thing. It's doing really great. And he says, well, what do you mean by really great? Well, I got between 30 and 40%. And you say, not going to do that. Next year, you guys are at the Christmas party again. He's like, dude, you got to get into the stock market thing, 40 to 50% returns. And you're saying, well, okay, maybe I will. So you jump in, and then what happens in 1929? Yeah, between 0 and negative 10. You're like, well, you know, I've only lost about 10%. It's not a big deal. I'll just hang in there. What happens in 1930? Yeah, you're between down 20 to 30%. You're like, this hurts, but I'm going to hang in there. 1931, what happens? Yeah, you're down minus 40 to minus 50%. Yeah, so let's see, where are we going next here? You say, well, I'll hang on one more year. And then 1932, we got between 0 and minus 10. You're like, you know what? Forget it. I'm going to take my $7 and leave, right? What happens in 1933? 50 to 60%. Damn it, right? Can you tell what's going to happen by what happened last year? Does this year tell you what's going to happen next year? No. Do today's returns tell you what's going to happen tomorrow? No. Don't believe people when they tell you they can look at these charts and they say, oh, wait a minute. Oh, yeah, well, that's a head and shoulders, so the stock's getting ready to take off. Or they'll come up with all sorts of crap. It reminds me of my sister and I. We would lay in the hayfield when I was a kid, and we'd look at the clouds. And I would say, wow, that one looks like a dog. And she'd say, you idiot, it's a horse. Now, what was it really? It was a cloud, right? And so you can look at this stuff and you can come up with these fancy pictures, but what we know is when we test these people who claim that they can do this, they never return. In fact, they always return a little worse than if we would have just invested in the S&P 500. Okay.
Can you go back and look at why? Is there value in looking at why the trends happen?
Oh, yeah. So you can go back year to year and figure out what's going on. But of course, it's all in the rearview mirror, right? And it is useful. Like I've been telling you guys, I lived through the internet bubble, and I want you to understand that there's an AI bubble forming, right? But how many of you are actually going to take that to heart? And in an efficient market, shouldn't it already be priced in? this is once again, it doesn't really do me any good to analyze stocks because you don't know what's going to happen. Tomorrow. We know these. It's like I said earlier, I could predict what's going to happen, but I can't tell you when. I'm sorry not to have been more encouraging for you guys today. Okay, now let's look down here at small stocks. By the way, where is the big middle finger on the top chart? It's between 10 and 20%. So that's pretty much where we expect things to be. Where's the big middle finger on the small company stocks? Yeah, between 20 and 30. Small stocks have to return more because they are riskier. Now, one of the things we can see to see the risk is look at this distribution. So for the large company stocks, it look more like this. For the small company stocks, it's like spreading out. And we can see that the lowest returns are between 50 and 60%, but check out the top return there, between 140 and 150%. You got a whole lot more possibility of spreading out with this one, and so it's riskier. So it has to return more, which is why its middle finger is between 20 and 30 instead of between 10 and 20. Does that make sense? Okay, how many of you are going to leave class today and go buy cryptocurrency? Good. Okay, I'll see you next time.